Welcome back to our series on the financial services industry. This is part 2 on securities pricing. I'll try to finish up. I know the previous video contained a lot of information. Again, the same disclaimer I always do to let you know that I'm not going to make any, this is a high-level review. It's publicly available information, and there's no trading advice offered here. So I kind of wanted to go through this again. Price, someone says what price, especially when you're looking at databases where they have somebody says, well, what's the price field? Price means different things. There's the purchase price, which is the price an investor paid for a particular security. There's the market price, which is what is the current price available in the market. There's the current price being the real-time price of security trading on an exchange. There's the trade price, which is the price of a specific trade. You did a trade, your trade executed, you got an NOE, a notice of execution, and what was the price that your trade executed at? There's the last trade price, and that's that in that exchange, in that market, what was the last price of the last trade prior to this, right? So if you bought a trade and you bought a security and you paid $27.10 a share, that would be your trade price. If somebody trades after you, they would then be the last price. Whatever was the last price to trade on that exchange, that's the last price. Then there's the opening price. What did the stock open at when the market's opened for that business day, right, on that exchange? Then there's a closing price. What did the price at the closing when the market's traded? And as I mentioned in the previous slides, there is after-hours trading. There is different markets, but generally closing price, we're talking about the closing price on the exchange for that business day on the primary exchange where you're listing. And we talked about the best price rule, the rule 14D-10, which basically says brokers can't play favorites. Customers have to all have a fair shot at getting the best price. Best execution. Brokers have to ensure that their customers are getting the best execution. If the broker can buy it for $10 a share in one spot, the broker shouldn't go and buy it someplace else at a higher price because maybe for whatever reason. If the broker is selling your security, he's going to sell it where he gets the best price for you. Now, this gets complex with a broker because you might want to buy 100 shares and there might be people, but they're only looking to buy, how many shares are you looking to buy or sell? You might only be looking to buy or sell 50 shares, and there's people out there who are looking to buy and sell 1,000 shares, right? So it becomes a little bit complex. Where do they pull the executions from? Now, that's all stuff I reviewed in the last video. Now we're going to talk about debt-specific price data. So when we're talking about stock markets, it's very easy to understand the idea that you have a bid, you have an ask, and it's an exchange, and there's a market, or there's an ECN, or electronic market. But as we start talking about debt products, not stocks, but we're talking about bonds and other debt products, it becomes a little bit more complex. Because one of the things we're doing, and it's not a price, but it falls within what I would consider the pricing reference data umbrella, is the ratings. So what happens is bonds have a ratings. They're graded in quality, right? And they're private companies, which supposedly or should be neutral third parties like Standard & Poor's, Moody's, and Fitch, and others who get paid to rate bonds and to rate them from anywhere from AAA to AA down to C, which are the lowest grade, which we consider junk bonds. Now, the ratings are not the price. Rating is not a price. Rating is not a price. But when you're considering price, and you're evaluating an asset and you're evaluating the value of a bond, the rating is a very essential piece of the data. And a broker is responsible, is obligated for making sure that they provide customers with access to the best possible, best available data from me. So if a broker is telling you that your bond is AAA, when in fact the rating agency is rating it as a single A, that's a problem, right? If a broker is selling you a security, you're looking to price a security, and you're going to price a bond, and maybe that issuer offers a bond that's a AA bond, and they also offer a bond that's a AAA bond, that information needs to be disclosed. The rating should be disclosed. Even though it's not part of the price, it's part of that reference data that brokerage firms have to source. Brokerage firms will source ratings data, some cases on nightly, some cases is weekly or bi-weekly, or different ratings come on at different times. But brokerage firms are constantly sourcing information from ratings companies so that they can correctly represent and rate their bonds that they carry for their customers. And this just shows you some of the qualities. Again, this is very important. It's dated on a monthly basis. I ran this for 10 years at a large firm as one of the pricing, and this is one of the things that's very important. Then this is called factors, right? Now, factors are another piece that gets factored into that gets considered when we look at pricing, right? And again, ratings are not a price, factors are not a price, but let's talk about factors. For bonds, bond factors relate to the pass-through securities that have had part of their principal paid prior to maturity. The bond factor is the proportion of the principal that is yet to be repaid, e.g. a bond factor of 0.85 means 85% of the principal has yet to be paid. So if you remember when I talked about in an earlier video about bonds, and I said that if you bought a bond and it paid a quarterly dividend payment, interest payment each quarter, over the life of that bond, that interest payment is going to get paid out. So the factor is used to identify for the bondholder and for the investor how many interest payments are left. In this example, right, we got a bond that says that 85% of the principal is yet to be repaid. So, it's that the factor is used for calculating if I have a bond, and whether it's a zero coupon bond or it's a coupon bond, the factor is used to calculate what is left in value in this instrument, right? And again, this gets really important when we're talking about the pay down for debt in general, but mortgage-backed securities, this becomes very complicated. So let's talk about mortgage backs. For example, if the face amount of a pool of mortgage-backed securities is $100,000, and the stated pool factor is 0.4587, that means that the remaining balance for the security yet to be paid to the investors would be $45,000, $45,870. So you had a mortgage-backed security, it had a value of $100,000, and it's been paying out to the bond to the holders for several years, but now there's only $45,000 of value left in that bond. So this is important for the data for the investor to know. Again, is it pricing data? Yes, it's part of the data that's needed to calculate the correct price on a particular asset. The pool factor is only used to describe the mortgage-backed securities, right? Which can be issued by Freddie Mac, Fannie Mae, Ginnie Mae. Okay, so that's what the factors are. Factors are used for debt products that have value that gets paid out over time to figure out how much value it remains in the asset. Now, you don't have this concept with equities, or you don't have this concept with mutual funds. This is a debt product concept, the concept of a factor. The factor is the number that you use to calculate how much value is remaining in the assets. So again, I did this slide, factors made easy, right? Factor. A factor is a fraction, I should say fraction here, I'm sorry. A fraction used to calculate the amount of principal yet to be paid. That's what a factor is. So how much of the principal of that bond has yet to be paid? That's what a factor is. Factor date is a date in which the corresponding factor is in effect. So you need to know that the factors change constantly as the bond, I won't say deteriorates, as the bond pays out value over time, right? A factor, for every time something gives you a factor, you need to know the date that that factor is as of. Now, then we talked on a previous meeting about mutual funds. So when we're looking at prices on mutual funds, there we're talking about bonds, now we're talking about mutual funds. Mutual funds have the idea of a net asset value. So a mutual fund's price per share or exchange traded funds per share value, right? This is calculated every night. So every night when the markets close, we take the closing price in the markets, in all the stock markets and the bond markets, and the mutual funds, the funds say the total value of all the liabilities over the shares outstanding equals the NAV price, the net asset value. So if you take all your assets and your liabilities, and you've got $1 million in the fund after all liabilities and the value of all the assets, if it's $1 million and you've got 100,000 shares outstanding, then the NAV price would be $10. So if somebody said, well, I own 10 shares. Okay, you own $100 worth of, the value of your 10 shares is $100, right? That's the net asset value, and it's computed nightly, right, by the mutual funds companies. And one thing interesting about mutual funds values, there are different pricing services that will publish mutual fund values, and they are published to the pricing services get their prices from the mutual funds companies. But one thing you're going to find is interesting is on a nightly basis, different sources might price a particular fund slightly different. And that's because there could be assets in that fund that are hard to price, that are hard to value, right? There might be holdings or liabilities that are hard to value. So they could be slightly off. Generally, they're pretty close, but they won't necessarily be to the penny. All mutual funds buy and sell orders are processed at the NAV of the trade date. However, investors must wait to the following day to get the price. So if you buy a mutual fund, when you put a buy order at 12 noon, you don't know what the price is you're going to get per share. You're going to say, I'm going to buy $10,000 worth of this mutual fund, but you don't know how many shares that's going to yield you. Or you can say, I want 1,000 shares. You don't know the exact price because it's all based upon the NAV, and the NAV isn't calculated until the end of the day. Yield, we talked about yield earlier. Mutual fund yields are the annual percentage measure of income, dividends, and interest earned by the fund's portfolio. So we gave you the example. We're talking about mutual funds in an earlier presentation. We talked about the value we set on a mutual fund. If you have a mutual fund that has $100,000, it produces dividends and interest of $11,000, and your expenses were $1,000, then the yield would be 10%, right? That would be how your yield for a particular fund would be. In addition, the SEC yield is an indicator of the percentage yield on a fund based on a 30-day period rather than the annual period. Market value, we talked about this earlier also, is the price of an asset would fetch from the market today. So if you executed today, what would be the market value? Now this becomes important when we're calculating the market value in order for, let's say, margin. So if you've got assets and we're going to produce your statement, and we want to say, well, what's the market value of Paul Judge's assets? They're going to go into my accountant, my accounts, and they're going to look at my securities, and they're going to calculate, given the closing price, what is the market value of the assets I hold? And that becomes important for tax reasons, and it also becomes important for like marginability, right? You know, what is my net worth? What are my assets? What's the value of the assets I have? Now, for a common stock, it's easy. It's the number of shares times the current market price. So what was the current market price? Well, if I have 500 shares and the current market price is 11.659, then the market value is 5,829.66. If it's units, we talked about units in an earlier presentation, which are the cash equivalent to the shares. Units are valued at the shares times the current market price, producing the market value. And here's an example where someone has 8,639 units for shares and has a current market price. Options are a little bit more different to calculate. For options, you take the contract times the delivery of shares, and usually contracts are in increments of 100, times the current market price. That's the value to the market. So if I have 28, if I have options on an asset and I've got 28 contracts and they're each for 100 shares and the current market price is $3.30, then the value of these contracts, these options, is $9,240. Fixed income products, bonds, we talked about earlier, face value or par times the current market price creates the market value. We took a fixed income with an index ratio, right? This was the example I talked about before, where there's an index ratio involved. Then it's the face value or par times the index ratio times the current market price, right? Because value has diminished over time. And then income with a factor. This is the example we talked about earlier also, where there's a diminishing value, where the factor would be 590777863. So it'd be face value times the factor times the current market price, and that creates a market value. So computing these values on a nightly basis is an essential part of what a brokerage firm has to do to figure out what is all this stuff worth? What are the portfolios worth? What are the client's assets worth? How much do we have to cover? What are our cash liabilities, our security coverage liabilities for regulatory purposes? So pricing data is essential. It's both essential in during the day, the business day, all day it's very important for executing trades, but then after the markets close, it's equally important for all your back office, post-execution, settlement clearing, regulatory reporting, tax reporting, and marginability and other activities. Where it's essential data to have. I hope this helps you with the ideas on pricing. Again, I'm Paul Judge. This is my email. Please feel free to contact me if you have any questions. And I hope to hear from you. Thank you.